This is not a gold and silver revaluation story breaking loose. It's a market that just got too crowded, too leveraged, and too stressed to stay calm. And the easiest way to misread it is to mistake volatility for revelation. Investopedia. Because here is the conflict right up front. The revaluation crowd wants you to believe there is a single switch, an official decree, a hidden reset, a grand announcement that forces gold and silver to reprice overnight. Meanwhile, the actual market just gave you a very different lesson. It ripped to records, then got punched in the face the moment leverage got tightened. And that is the opposite of a guaranteed reset. Bloomberg. Calm. If you want the honest takeaway right now, it's this. The price is loud, but the structure is louder. And the structure is where the truth leaks out first. Gold was sitting near record levels late December. Then it dropped hard in a single session. Spot fell over 4% to around $4,350 after touching roughly $4,565 days earlier. Silver did the same kind of faceplant, dropping close to 9% to the low 70s after trading above 80. Investopedia. That kind of move is exactly where revaluation narratives are born. Not because revaluation is happening, but because when price action becomes too violent to explain in a tweet, people reach for a single dramatic cause. And you can hear it already. They can't hold it down anymore. They're going to revalue reserves. They'll reset the system. This is the official repricing. No, slow down. If a revaluation story is real, it has a paper trail, a legal mechanism, a balance sheet pathway, and an incentive structure you can point to. If it's not real, it is usually just a story stapled to a market that was already moved, because the brain hates uncertainty, and volatility feels like a conspiracy when you don't understand the plumbing. So let's do this the way the market actually works. Mechanism first, then proof, then the what comes next. And only then, where revaluation fits as a possibility, not a prophecy. Start with definitions, because this is where most people get tricked. When people say revaluation, they're usually mixing three very different things into one dramatic word. 1, book value revaluation. That's accounting. That's a government or central bank changing the valuation method of an asset on its balance sheet. 2, monetary revaluation. That's currency regime stuff. Pegs, resets, redenominations. Rare. Political. Messy. 3, market repricing. That's simply price discovery. Buyers and sellers resetting the clearing price because conditions changed. In the gold world, the biggest revaluation meme comes from one strange fact that sounds like a smoking gun, but is mostly a historical artifact. The U.S. Treasury carries its gold at a statutory book value of $42. $20 per ounce. Not market, not a fair value mark. A fixed statutory number. Bureau of the Fiscal Service. So the story goes like this. If they just revalue that gold to the market price, boom, hundreds of billions appear on the balance sheet. Debt gets paid down and gold must soar. Well, that story has a kernel of truth and a mountain of fantasy. Yes, a revaluation of the statutory book value would mechanically create accounting gains. That part is real. The Treasury itself publishes that statutory book value. Bureau of the Fiscal Service. And the Federal Reserve explains the structure. The Fed doesn't own gold, the Treasury does. The Fed holds gold certificates as an asset issued by the Treasury, and those certificates are tied to the statutory price. Not redeemable for gold, not a claim on metal. It's basically a legacy accounting instrument. Federal Reserve. So could the statutory price be changed by law? In theory, yes. Would that automatically revalue the market price of gold and silver? No, because the market price is not set by what the Treasury writes in a ledger. The market price is set at the margin every second through the futures curve, the physical market, the hedging flow, the ETF creations and redemptions, central bank demand, and the cost of financing and delivering metal. And that's the first micro trap. People assume balance sheet valuation equals market repricing. It doesn't. A book value change can matter politically. It can create room for transfers. It can shift optics. It can create a narrative. But it does not guarantee your chart goes vertical. And here is the part most revaluation talkers want to tell you, even serious economists. And policymakers who discuss reserve revaluations treat them as rare, conditional, and constrained, not as a magic debt eraser. Federal Reserve. So if you came here hoping I'd scream revaluation confirmed, you're in the wrong room. But if you want the real setup, the one that can actually move price in the next week or two, stay with me, because the hidden detail is the opposite of a headline. The hidden detail is where stress shows up first, spreads and structure. The price is the billboard. The spreads are the wiring behind it. When gold and silver are calm, the futures curve behaves like you de-expect. Contracts further out trade a bit higher than spot because of Carry, interest rates, storage, insurance, financing, that's contango. It's the market saying time costs money. But when the market gets tight, when immediate demand or immediate deliverability matters more than later delivery, the curve can flatten or invert. That's backwardation. That's the market saying now is worth more than later. And when that happens, it forces behavior. Because if front-month metal is more expensive than future metal, it creates arbitrage incentives, inventory incentives, and stress in lending markets. It squeezes the people who are short near-term deliverability. It rewards those who can source and deliver now. And it makes paper promises more expensive to maintain. That's where the real pressure starts. Now, I'm not going to pretend I can see every warehouse ledger in the world in real time, and I'm not going to invent precise inventory numbers to sound impressive. But you don't need fake precision. You need to know what signals to watch. One signal is the curve itself. Another is the cost to borrow metal, lease rates and forward rates. When the cost to borrow metal spikes, it is telling you immediate physical availability is tight relative to demand, at least in specific channels and tenors. And in 2025, there has been a lot of talk in the market about tightness signals, lease rates behaving unusually, forward curves showing stress in specific windows. Treat that as a clue, not a conclusion. Gainesville coins. Because the key distinction is this: tightness is not the same as depletion. A market can be tight because demand is surging, because financing is expensive, because inventory is in the wrong place, because logistics are constrained, because refiners are bottlenecked, because metal is being pulled into one region, or because paper hedges got too large relative to deliverable float. And that matters, because revaluation implies some external authority reset. Tightness implies something else, supply chain reality colliding with paper leverage. And that collision is what 2025 has been about. Look at the surface level first. Performance. In 2025, precious metals didn't just grind higher, they dominated. Reuters summarized it bluntly. Gold up roughly 2/3 on the year, silver up dramatically more, with precious metals outperforming many other assets. Reuters. Oh, that kind of run does two things at once. It attracts long-term buyers, people and institutions who want insurance, diversification, and a hedge against currency and policy uncertainty. And it attracts short-term leverage, people who don't want insurance, they want acceleration. That second group is where the danger is, and it's also where the biggest bull moves are born. Because leverage creates reflexivity. It makes price action feed on itself. Here's how. When gold and silver rally hard, traders pile into futures and options. Options markets grow, volatility gets bid. Dealers who sell options have to hedge, and those hedges can become self-reinforcing when the market moves through key strikes. This isn't conspiracy. This is mechanical. If a dealer is short call options and the price rises, the dealer's delta exposure changes. The dealer buys futures to hedge. That buying pushes price higher. That can push price into the next cluster of strikes. That triggers more hedging. That can create a gamma-driven squeeze. It's not that someone decided to revalue gold. It's that math-forced buying. And it matters right now because options activity in gold has been heavy. CME itself highlighted strong activity in gold options during Q4 2025, which tells you participants were using options aggressively, either to speculate or to hedge large exposures. CME Group. But here's the twist. The same math that forces buying on the way up can force selling on the way down when risk managers step in and margin changes hit. And that's exactly what the market just showed you. On December 29th, gold and silver dropped sharply after CME raised margin requirements for precious metals, a classic response to extreme volatility. Investopedia. This is the calendar trigger you cannot ignore because we're not in a normal week. We're in the turn of year window, thin liquidity, year-end book management, tax timing, fund rebalancing, and risk committees that suddenly care a lot more than they did when the trend was clean. Year-end doesn't just close a calendar, it compresses tolerance. Funds look at P&L and say, protect it. Desks look at risk and say, shrink it. Brokers look at volatility and say, raise margin. And the moment margins rise, leverage stops being a choice. It becomes a bill. Investopedia S recap captured the key point. The margin hike raised the amount of capital required to trade futures. And that can trigger waves of profit-taking and de-risking, especially after a rally to record highs. Investopedia. In other words, the market just told you loudly that leverage is a dominant driver. And that is why you must be skeptical of simplistic revaluation interpretations. Because if a single margin hike can knock the market down 5 or 10% in a day, the setup is not official repricing. The setup is positioning and leverage inside a volatile structure. That's not bearish, that's reality. And reality is what keeps you from getting emotionally harvested. Now layer in the next piece of proof. Who is buying and why? The strongest bullish case for gold is not a viral decree story. It's persistent, relatively price-insensitive demand from institutions, especially central banks and ETFs, combined with a macro backdrop that makes non-yielding assets more attractive when real yields stall and currency trust gets questioned. The World Gold Council ACE-owned data has shown periods of heavy ETF demand and continued central bank buying in 2025. For example, their Gold Demand Trends report for Q3 2025 highlighted large ETF inflows and elevated central bank buying in that quarter. World Gold Council. That matters because those flows do not behave like retail leverage. ETF inflows create real physical demand through the creation process. It's not always immediate, and it's not always one-to-one, but in the aggregate, it's meaningful. Central bank buying is even more strategic. It's not chasing a breakout candle. It's shifting reserves over years, often for geopolitical and diversification reasons. Reuters and other coverage throughout 2025 has pointed to central bank demand as a key pillar behind the metal's strength. Reuters. And now here is a piece of street-level evidence that cuts through the noise. India. India is one of the world's most important gold markets, and what happens there tells you whether the move is being absorbed as jewelry demand, investment demand, or both. On December 31st, Reuters described how record gold prices reshaped Indian buying behavior. Jewelry demand fell, while bars, coins, and ETFs gained share, pushing investment gold to a record portion of demand. Reuters. Read that carefully, because it's subtle. When prices explode, traditional jewelry demand can get priced out. People balk at making charges. They go lighter, they go lower carat, or they step back. But investment demand can rise at the same time because fear and uncertainty don't care about making charges. They care about ownership. That split tells you the rally is not purely a love trade. It's partly a trust trade. And that's important because revaluation talk tries to claim an official inevitability. The real story is more human. The more uncertain the regime feels, the more people shift from consumption to investment. That doesn't mean price can't fall. It means the demand composition is changing. And that's the part that matters. Now let's bring silver into the frame, because silver is where the narrative gets even more dangerous and also more interesting. Silver is not just a monetary metal. It's an industrial metal with a monetary shadow. That dual identity is why silver is violent. When industry needs it, it doesn't care about your chart pattern. It needs ounces. It needs delivery. It needs consistency. When investors chase it, they don't care about your supply chain. They care about acceleration. Put those together in a year of tight supply and surging demand, and you get a market that can go vertical, then drop 10% in a day without blinking. Reuters' year-end summary highlighted Silver Era's extraordinary performance in 2025 and pointed to constrained supplies and demand forces as contributors. Reuters. And you just saw the other side of the coin. When CME raised margin requirements, silver got hit hard. Economic Times reported the margin increase on a silver contract and the sharp intraday declines that followed. Classic leverage compression. The Economic Times. So here's a clean, finance-literate way to interpret silver right now. Silver's upside can be structural, industrial demand, deficits, procurement cycles, green energy build-out. But silver's downside can be mechanical, margins, leverage positioning, forced liquidation. Those two things can coexist. And if you don't respect that, you'll get emotionally played. Now let's talk about the part everyone always misunderstands. Paper versus physical. This phrase gets abused into conspiracy territory. Don't do that. You don't need cartoon villains to explain paper physical tension. You just need incentives. Futures markets allow leverage and hedging. Producers hedge, consumers hedge. Speculators take views. Dealers intermediate. Most contracts get netted and rolled. Very few go to delivery. That's normal. But when physical tightness appears in certain windows, the cost of staying short the front end can rise. The spread between nearby and deferred contracts can scream. Borrowing costs can spike. Delivery optionality becomes valuable. That's where the market reveals stress. And this is where global arbitrage becomes the quiet killer of simplistic narratives. Because gold is global, but it doesn't trade at one price everywhere. It trades as a network. If Shanghai trades at a premium to London, metal gets pulled into China. If it trades at a discount, imports slow and pressure can weigh elsewhere. LBMA has discussed the linkage between Shanghai premiums and the international price. Premiums tend to attract flows. Discounts tend to repel them. LBMA. That's not a theory. That's basic arbitrage. And Bloomberg reported earlier in 2025 about gold flowing into Shanghai warehouses linked to futures delivery, tied to arbitrage conditions, and demand for futures trading at a premium. Bloomberg.com. Here's con is why that matters for your revaluation. Skepticism. If the market is truly being officially revalued, you would expect a clean repricing narrative. But what we actually see is a messy network, premiums, arbitrage, inventory relocations, Futures premiums relative to physical and regional flow incentives. That's not a one-switch reset. That's a complex system under stress. And when complex systems are under stress, they do not move in straight lines. They whip, they lurch, they gap. And the next detail flips the whole setup. The turn-of-year window amplifies every one of these mechanics. Liquidity thins. Order books get fragile. One big order moves price farther than it should. Stops get triggered. Volatility spikes. And then margins rise again, because clearinghouses aren't in the business of hoping for the best. This is not a normal environment for clean, narrative-friendly price discovery. It's an environment where weak hands get punished. So the first practical lesson right now is not buy the revaluation. It's understand the squeeze points. Here are the squeeze points you can actually watch without needing secret documents. 1. Margin policy. When CME raises margin, it tells you volatility has reached a threshold where the system is protecting itself. It forces cash to the table. It punishes excess leverage. Investopedia. 2. Options positioning into key dates. Heavy options activity can create strike magnets and gamma effects. If price pins near big strikes into expiry, that's not necessarily manipulation. It's hedging gravity. 3. The curve. If the front end stays firm relative to deferred, it suggests immediate demand tightness. If the curve relaxes quickly after a margin event, it suggests the move was largely leverage. 4. ETF flow persistence. Big inflows tend to be sticky until the macro regime shifts or momentum breaks. WGC has documented meaningful ETF demand in parts of 2025. World Gold Council. 5. Central bank behavior. Not day-to-day, but the trend. When central bank buying remains elevated, it changes the floor psychology of gold. A World Gold Council. 6. Street-level demand composition. If jewelry demand collapses but investment demand rises, that tells you the bid is fear-driven, not purely consumption-driven. Reuters gave you exactly that picture in India at year-end. Reuters. That is already a 6-layer proof stack, and none of it requires a decree. Now let's address the counterpoint honestly. Could an official revaluation happen anyway? Yes, countries have revalued reserves. Yes, it's been discussed. Yes, policymakers have floated using valuation gains in certain ways. And the Federal Reserve has even published research reviewing official reserve revaluations and the international experience, noting the idea has been floated in places like the US and Belgium, Federal Reserve. But here's the key. Even when it's floated, it's treated as rare and constrained. And there's a deeper reason for that. Revaluation does not eliminate liabilities. It reshuffles them. A serious analysis in the financial press has pointed out that even if revaluing gold increases the Treasury OS assets, on paper it doesn't necessarily reduce consolidated government debt in any meaningful way. It can shift burdens between Treasury and the central bank and create interest cost dynamics that offset the gain. Financial Times. So if your revaluation thesis is literally free money appears, debt disappears, gold goes to infinity, that thesis is fragile. And fragile theses are the ones volatility loves to destroy. Also, a revaluation rumor can become a tool of its own, because once a crowd believes an official reset is coming, they will buy without a plan. They will leverage, they will chase, and then a normal pullback will feel like betrayal. That is how people get wrecked in bull markets. Let's talk about how this psychological trap is set, because this is the shield you need. The market will try to manipulate you with time and speed. First, it accelerates. You feel late. You chase, you take too much size, then it snaps back. You feel stupid. You sell. Then it grinds. You feel numb. You stop paying attention. Then it rips again. You feel angry. You chase again. This cycle is not random. It's how volatility harvests emotion. And in a thin liquidity window like late December into early January, the whipsaw potential is higher, even if the broader trend is still bullish. So you need two mental anchors. Anchor 1, trend signal versus noise. A trend signal is a higher time frame break and hold, price establishing a new zone with flows that persist. Noise is a violent move driven by leverage, margin, and thin liquidity that reverses quickly once conditions normalize. Both can happen in the same week. Anchor 2, two scenarios, always. Because if you only have one scenario, you don't have a plan. You have a hope. Scenario 1, controlled pullback and retest. This is the healthy bull path. Price pulls back toward a breakout zone, volatility compresses, weak longs get shaken out, and then the market attempts to build a base. If the curve stays relatively firm and ETF central bank demand stays supportive, this path can set up a second leg higher. Scenario 2, continuation squeeze and gap risk. This is the violent bull path. Price refuses to give a clean entry. It chops, then rips through key levels, forcing hedgers and shorts to cover. Liquidity thins, and the market can gap. This is where people feel genius and then get punished by a sudden air pocket. Both scenarios are plausible after a year like 2025. Reuters. And the difference between them, one to be decided by a headline. It will be decided by structure. So what do you watch next week and the week after? You watch the levels, but you watch the behavior around the levels more than the levels themselves. If gold bounces hard after a margin-driven flush and then fails to reclaim key highs, that's not necessarily bearish. It can be digestion. But if it retests a major zone and then slices through it with volume and keeps going, especially if the curve relaxes and flows reverse, that's a warning. If silver holds above a former breakout region and volatility calms while industrial demand narratives remain intact, that's constructive. If silver keeps needing new leverage to go higher, parabolic candles followed by margin hikes and 10% drops, that S assign the move is being driven more by positioning than by orderly accumulation. And that's where the real pressure starts again, because positioning-driven markets can extend far beyond logic, but they also collapse far faster than logic. Now, I want to add one more piece of evidence that most people misinterpret: inventories. People love to scream inventories down, squeeze confirmed, or inventories up, fraud exposed. Reality is more nuanced. Inventories can rise for reasons that are bullish or bearish, depending on context. If inventories rise because metal is flowing into a deliverable system due to arbitrage incentives or tariff fears, that can be a sign of stress elsewhere. Reuters reporting earlier in 2025 discussed gold stocks in COMEX warehouses, rising amid concerns about import tariffs, curtailing shipments, flows that are driven by policy uncertainty and logistics incentives. A Kitco. That doesn't automatically mean plenty of supply forever. It means metal is relocating to where it can satisfy delivery needs and hedge structure. That's a flow story, not a simple, abundant story. And flows are exactly what matter in a revaluation rumor environment, because rumor buyers ignore flows and fixate on destiny. Now let us reconnect this to the opening promise. What is the concrete payoff later in the video? Here it is. If you want to know whether this market is actually undergoing a structural repricing, or whether it is just leverage and narrative, you need one core checklist. Not 10 indicators. One checklist. I call it the structure stack. First, did the margin event clean out leverage, or did it break the trend? A margin-driven sell-off that gets bought and stabilizes is often a reset, not a reversal. Investopedia. Second, is the bid coming from sticky sources? ETFs and central banks are sticky compared to retail leverage. WGC data suggests meaningful investor demand in parts of 2025, and central bank buying remained elevated. World Gold Council. Third, is physical signaling stress in the right places? Watch premiums, watch the curve, watch borrowing costs. Don't treat any single metric as gospel. Treat them as a dashboard. Fourth, are regional flows amplifying or damping price? If premiums in key regions persist, they pull metal. If discounts persist, they release pressure. LBMA's explanation of how SGE premiums connect to international pricing gives you the conceptual map. LBMA. Fifth, is the narrative getting louder as the structure gets weaker? That's the tell. When structure is strong, price doesn't need a myth. When structure gets fragile, myths multiply, and that's where the real pressure starts. Now let's bring the revaluation story back in, but in its proper place. As a tail risk, not a base case. If the US or another major actor changed how gold is valued on its books, it could create a political story and a balance sheet story. Treasury's own gold report confirms the statutory book value, Bureau of the Fiscal Service, and the Fed's research notes that discussions about using valuation gains have been floated, while also emphasizing the rarity and constraints. Federal Reserve. Even if something like that happened, the market response would not be a simple upward line. It would depend on how it's implemented, what liabilities shift, how the currency reacts, how rates react, and how global trust responds. A juris-study revaluation could even create a momentary paradox. If markets interpret it as a desperation move, gold could spike. If they interpret it as a fiscal trick that strengthens confidence, gold could react differently. If it pressures rates, it changes carry costs. If it changes FX expectations, it changes global demand. That's why serious analysis treats it as complex. Financial Times. So here's the disciplined stance. Be open to the possibility. Be skeptical of the certainty. The market is not your storyteller. It's your examiner. And the test at S giving you right now is simple. Can you separate mechanism from myth? Because the mechanism case for gold and silver is already strong enough without revaluation. Gold has had a year powered by uncertainty, institutional demand, and a macro backdrop that can support a hard asset bid when the dollar weakens and rate expectations shift. Reuters. Silver has the added fuel of industrial demand and supply constraints, meaning it can outperform, but it can also whip you around like a weapon. Reuters. And the calendar is pouring gasoline on everything. Turn-of-year liquidity, margin dynamics, and positioning resets. Investopedia. So what happens next week? Here's the roadmap in plain English. If this was a leverage flush, you'll often see a violent drop, then stabilization, then a choppy retest. Volatility stays elevated, but starts to compress. The market tries to rebuild. In that environment, the best signal is not a green candle. It's resilience. Does gold hold key zones without needing a daily rescue? Does silver stop doing 10% intraday swings? Do spreads and the curve stop screaming? If yes, the bull case stays alive. If instead you see repeated failed bounces, price pops, then collapses, then pops weaker, while margins stay high and liquidity stays thin, that's a warning the market is still too crowded. And if you see a sudden rip that ignores pullbacks, be careful too. Because that's the squeeze scenario, exciting, profitable for disciplined positioning, but dangerous for emotional chasing. In the squeeze scenario, price can gap. It can run stops. It can make you feel like you missed the move. That's where most people blow up, not because they were bearish, but because they were late and oversized. So let me give you the simplest risk framing that actually works. Assume the thesis can be right and price can still whip around violently. Assume you can be correct on direction and still get punished on timing. Assume volatility is not evidence against the thesis, it's the cost of admission. That's not fear, that's professionalism. And that brings me to the subtle warning most people never hear. Volatility will be used against you, not by a villain, by the structure. When price moves fast, your brain wants certainty. It wants a story. It wants an authority. That's why revaluation narratives feel comforting. They turn a chaotic market into a scripted movie. But markets don't run on scripts. They run on constraints. Cash constraints, margin constraints, inventory constraints, hedge constraints, political constraints. If you want trust and results, you stop chasing certainty and you start tracking constraints. So here's the one metric revelation I promised at the start. If you only watch one thing beyond the headline price, watch whether structure keeps confirming urgency. In practice, that means watch the behavior of the front end versus deferred, watch whether physical signals stay firm, and watch whether margin-driven flushes get absorbed or compound. Because when urgency persists, somebody is being forced to act. Procurers, hedgers, shorts, dealers. When urgency fades quickly, the move was likely more leverage than structure. And that's the detail that flips the whole setup. Now, I'll end with a community note that isn't begging, because the audience this channel is for isn't here to be entertained by slogans. This is for people who want to think like the market, not like the crowd. If you're the kind of investor who wants the mechanism, not the myth, stick around, because the next 2 weeks are going to separate the disciplined from the emotional, and the market always pays the disciplined eventually, even if it taxes them up front with volatility. Be skeptical of revaluation certainty. Be alert to structural signals. And be ready for 2 scenarios, not 1. Because if one key level breaks, the math changes. And if one key spread holds, the pressure comes back.